With the increasing popularity of Bitcoin, now seems like the perfect time to explore some of the most famous myths and misconceptions about the world's first cryptocurrency. We'll examine whether these beliefs hold any truth and set the record straight. Without further ado, let's get started. Myth number 1. Bitcoin is a bubble. Bubbles are economic cycles with unsustainable surges in price, which eventually burst when investors realize that the price far exceeds an asset's actual worth. In other words, many people believe that Bitcoin will eventually become worthless. Bitcoin is often compared to the 17th century Dutch tulip mania, where speculators caused tulip prices to skyrocket 26 times before the bubble burst in just 6 months, leading to a collapse from which it never recovered. But while it's true that some people purchase Bitcoin as a speculative investment, hoping to easily make huge gains, this doesn't mean Bitcoin itself is a bubble. The truth is, Bitcoin has experienced multiple price cycles over more than 12 years, each time rebounding to reach new highs. Boom and bust cycles are expected with any emerging technology. For instance, during the dot-com era of the late 1990s, many tech stocks saw rapid valuation increases followed by significant crashes. Amazon stock, for example, plummeted from around $100 to just $5 at the end of the dot-com bubble, only to become one of the most valuable companies globally in the following decades. This illustrates how speculative bubbles can impact various asset classes, including crypto assets, which may experience similar volatility and risk before stabilizing or achieving long-term growth. Some prominent Bitcoin investors believe Bitcoin's fluctuations follow a pattern typical of young markets. They suggest Bitcoin will surge and recede with smaller swings and longer intervals between them until it eventually stabilizes. Myth number 2. Bitcoin isn't secure. The Bitcoin network has never been hacked. Its open source code has undergone extensive scrutiny by numerous security experts and computer scientists. Bitcoin was also the first digital currency to solve the double spend problem, making trustless, peer-to-peer currencies a reality. Moreover, all Bitcoin transactions are irreversible. Many misconceptions about Bitcoin's security arise from attacks on third-party businesses and services that utilize Bitcoin, not the Bitcoin network itself. High-profile hacks of early Bitcoin companies with flawed security measures and occasional data breaches have led some to question Bitcoin's security. Additionally, Bitcoin's core protocol has operated securely with 99.9% uptime since its inception in 2009. A vast amount of computing power secures the network, and the miners that support it are distributed across the globe, with nodes in over 100 countries. This global distribution means there are no single points of failure. Myth number 3. Investing in Bitcoin is gambling. While it's true that Bitcoin has experienced significant price volatility over the last decade, this is expected in a young and growing market. Since Bitcoin's genesis block in 2010, it has steadily gained long-term value, with a market cap around $1.3 trillion as of June 2024. As Bitcoin continues to mature, regulatory frameworks are being established, and institutional adoption is increasing, as it did for Tesla and various hedge funds. Bitcoin investors have a fundamental rationale to believe that the value of their holdings will rise, unlike in a casino where the odds favor the house. Although there are no guarantees about future performance, Bitcoin's long-term trend over the past decade has been upward. One popular strategy to mitigate volatility is dollar-cost averaging, where you invest a fixed amount regularly, regardless of market conditions. Bitcoin's volatility appears to be decreasing in the past few years. A recent Bloomberg analysis compared Bitcoin's current bull run to the 2017 boom and found that volatility is significantly lower this time. This is due to the rise of institutional participants and the stabilizing effect of crypto going mainstream. In early 2024, a significant development occurred in Bitcoin investment. Spot ETFs for Bitcoin were officially approved in the US. Unlike previous perceptions of Bitcoin investments as gambling, these ETFs provide a structured and regulated way to invest in Bitcoin. With increased oversight and regulation, these ETFs could attract a broader range of investors, making Bitcoin more seamlessly integrated into traditional investment portfolios. Myth number 4. Bitcoin doesn't have real value. Although Bitcoin isn't backed by a physical asset like gold, neither is the US dollar or most modern fiat currencies. Bitcoin is designed to be scarce, making it resistant to inflation. Inflation can occur in fiat currencies when large quantities are created, thereby diluting the existing supply. Only 21 million Bitcoin will ever exist, and this scarcity significantly contributes to its value. In addition to the supply cap, the rate of new Bitcoin being mined decreases over time in a predictable manner. Every 4 years, during an event known as the halving, the block rewards paid to miners are cut in half. This mechanism ensures a decreasing supply, which, according to the basic economic principle of scarcity, has helped keep Bitcoin's price generally trending upward over the long term, from less than a penny at its inception to over $64,000 as of mid-June 2024. Bitcoin also derives value from the work done by computers on the network through a process called mining. Powerful computers around the world provide immense processing power to validate and secure every transaction, for which they are rewarded with new Bitcoin. Myth. Number 5. Bitcoin has no real-world uses. Critics often argue that Bitcoin isn't practical in the real world, or claim its primary use is for illicit activities. Neither assertion is accurate. Bitcoin has a long-standing history as a payment method, enabling transactions with anyone globally without needing a bank or payment processor. It's also increasingly used as a hedge against inflation by major institutional investors. In recent years, Bitcoin has gained popularity as an inflation-resistant store of value, akin to gold, earning it the nickname digital gold. An increasing number of major funds and publicly traded companies, such as Tesla, Square, and MicroStrategy, have invested millions or even billions of dollars in Bitcoin to better manage their assets. Similar to gold, Bitcoin is scarce. While gold has a long history as a stable store of value recognized globally, Bitcoin's digital and intangible nature is seen as a drawback by those who prefer physical assets. Relatively, gold is also stable in terms of price volatility, while Bitcoin is known for its significant price fluctuations, which can present opportunities for high returns but also entail higher risk. Regarding convenience, Bitcoin can be sent digitally as easily as an email, making it more suitable for modern financial transactions. Gold, being heavy, bulky, and difficult to transport and store, poses logistical challenges. Myth. Number 6. Bitcoin will just be replaced by a competitor. Bitcoin was the first truly successful digital currency. Despite new cryptocurrencies consistently promising to surpass Bitcoin, with new features or other advantages, none have come close. Over the past decade, thousands of rival cryptocurrencies have been created. Yet Bitcoin has always been and remains the most valuable cryptocurrency by market cap by a significant margin. It is also the most popular, accounting for around 60% of the crypto market. Bitcoin's dominance is attributed to its first-mover advantage and the purity of its mission as a decentralized and open currency. However, this doesn't mean competitors aren't welcome to try. Bitcoin's decentralization means it is operated by a global community of miners and nodes rather than a central authority. Myth number 7. Bitcoin is bad for the environment. Bitcoin mining is indeed energy-intensive, but assessing its environmental impact is complex. Firstly, all sectors of the digital economy consume energy. Consider the global banking system, which requires energy for processing transactions, powering offices, ATMs, branches, and more. Recent research by ARK Investment Management based in New York concludes that Bitcoin is significantly more efficient than traditional banking and gold mining on a global scale. A substantial portion of Bitcoin mining utilizes renewable energy sources, such as wind, hydro, and solar power. According to the Cambridge Bitcoin Electricity Consumption Index, this ranges from 20% to over 70%. Cambridge researchers have also stated that Bitcoin's environmental footprint currently remains marginal at best. That said, an argument can be made that Bitcoin mining's economic incentives actually foster innovation in sustainable energy. Miners continually strive to boost profits by reducing electricity costs. And in a world where renewable energy is increasingly economical, this trend could drive further adoption of sustainable energy solutions. As we wrap up our look into Bitcoin's myths, whether it's its ability to weather market ups and downs or its potential as a global digital asset, Bitcoin keeps challenging what we thought we knew. Feel free to share your thoughts in the comments below and continue the conversation. If you found today's video informative and would like to receive more insights and updates on crypto, global finance and beyond, please consider liking the video, subscribing to our channel, and turning on post notifications. Keep questioning, keep exploring, and most importantly, keep investing wisely. Thank you for watching, and we look forward to seeing you in the next video.